Congrats, guys. We finally did it. We are officially at a new all-time high for daily mortgage rates over the last 20 years. What's up, guys? It's McKeown back again with another video this week. All jokes aside, this sucks. Now, if you've been following the real estate market, it has come to a screeching halt. A screeching halt oftentimes happens in a housing market when you have interest rates that essentially double in less than a 6 months time span. If you've watched some of my videos, you know that I closed on a property for an investment property, which oftentimes is about 1% higher than a traditional owner-occupant home at 3.75% in December. That means if I would have, occupied the house, I could have probably gotten in the high twos. Now, I can tell you with a house under contract, which TBD if I even wind up closing on it. I will close on it, but I'm just not going to love the interest rate that I'm gonna wind up getting because it's still 2.5 months out from closing and it's a new build. Now that's a whole nother story in itself, but with interest rates effectively as of yesterday, we have officially gone over that 7% threshold. Again, 7% interest rates at the end of September in 2022, when just 9 months ago, as I just mentioned, I got 3.75% for an investment property. Now we did have a spike back in June that led us to the first time above 6% in quite some time. Things kind of leveled out, and for some people we thought interest rates were going back down. Unfortunately, due to inflation, especially most recently when we heard that inflation is not really being combated and it's not really getting better, interest rates effectively are now above 7%. Now, if you're not in the real estate world on a daily basis, I'm gonna break this down for you and explain to you why this is such a big deal. Now, obviously higher interest rates means, less people are going to purchase. Less people are going to purchase because they are keeping the, house that they're sitting on a 3 or 4% interest rate. They're less likely to sell and buy another property because they're going to be taking a 3 or 4% interest rate and upgrading to a larger or maybe smaller house on a higher interest rate. So oftentimes people are not going to sell. Now, what does that mean for the market as a whole though? It means a lot, and it's hard to break it down just in one sentence or one quick video, but what I want to tell you guys is it's going to make a huge impact moving forward. Now, the real estate industry that not a lot of people understand or realize is it's not just affecting me as a realtor. Now, obviously my business is going to slow down, and most realtors' businesses are gonna slow down because we're selling less homes. Less homes are being sold, less homes are being bought because obviously interest rates are significantly higher than they just were 6 to 9 months ago. But on top of that, we're also gonna be struggling with builders slowing down. Builders offering huge incentives to get rid of homes that have been sitting as a inventory home for 3 months, 6 months, 9 months and not sold because no one essentially has the ability to purchase it, or maybe there's better options out there. Now on top of that, you're gonna have builders that employ individual agents. They employ plumbers, they employ electricians, they employ roofers. The entire process of building a home, you're gonna wind up employing a substantial amount of people and giving work to a substantial amount of people. That's gonna come to a screeching halt. Now, I also saw a recent news article that 70% of individuals that are employed are looking for additional sources of income to be able to combat inflation and just the really rising costs of everything. Or people are being laid off, so they're having to find 2 part-time jobs rather than 1 full-time job. And in this situation, especially moving forward, if this doesn't kind of correct itself, you're gonna see a lot of people lose a lot of jobs, and the economy is going to be in a very tough spot. So yes, rising interest rates are going to have a significant impact to the economy. It's obviously going to affect more than just myself as a realtor. As I just mentioned with new builds, it could affect a ton of people. Also, we're talking title companies, we're talking lenders, we're talking any and all real estate agents, and also any other individuals that are just associated with real estate in general. But from the consumer side of things, let's just go back to a buyer's perspective, okay? A buyer's perspective, 6 to 9 months ago, getting an interest rate in the high 2s or mid 3s versus getting an interest rate now in the 7s. Let me just give you an idea of what that looks like. So we're gonna use $400,000 as that's a rough kind of average price point for my local market in the Dallas-Fort Worth area. Now, if you're in California, obviously this is going to impact you even more heavily, the New Yorks, the Chicagos, those larger markets, but let's just use $400,000 as an average price point. So at $400,000, putting 5% down, you're putting about 20 grand down. At a 3.5% interest rate, you're gonna be paying PMI because you didn't put 20% down, which is fine, but you're looking at a monthly mortgage payment of $2,900, a little under $2,900. Now that's in the state of Texas with a little bit higher property taxes, but remember, $2,885 or a little bit under $2,900. And to further break that down for you guys, about $1,700 of that is going towards principal and interest. The rest obviously goes towards taxes, insurance, and PMI. Now let's go ahead and jump, the interest rate to where it roughly is now, 7%. So from 3.5% to 7%, you're looking at a substantial difference in that principal and interest amount, jumping from $1,700 to almost $2,550. So really, what does that mean? That means over $800 a month. If you had bought in a house, 6 to 9 months ago and got about a 3.5% interest rate versus buying the same exact priced house now, still $400,000 at a 7% interest rate, you're now paying north of $800 more in just interest alone. Me, myself, I can give you an example. I had a rental property at one point that had a tenant paying me $800 a month. So you can imagine how big of an impact this is going to have. We're talking about just in interest alone, about a 30% increase just solely off interest, guys. Now my take on all of this and the significant increase, especially last week and this week, finally hitting that 7% threshold with mortgage interest rates, a lot of it's backing off of what the Fed came out with last week. Now, if you saw last week, yes, the Fed did do a 3/4 of a rate hike. They did that after they found out that inflation is still continuing to be an issue and not being resolved. Now, what I can tell you is if we do get the situation with inflation back down to that 1 to 2%, obviously we're at about 8 or 9% now, but once that comes back down, mortgage rates will fall with it. Now, there is one kind of solution that I just got brought to my attention today, actually, mostly because, as I mentioned before, I have a new build house being completed the first week probably of December, maybe mid-December, and I'm even concerned about, am I gonna be at an 8%, a 9% interest rate at that point, or is inflation going to be taken care of, or is it gonna be on the mend at that point where interest rates will start kind of coming down, or not necessarily going up as crazy fast as they have the last week and a half. But what I got brought to my attention is a 2-1 buy down. Now, what that means is essentially you can get a lender to do this option for you, and it basically means that first full year, you actually, instead of, let's say I got quoted a 7.25. Now, that first full year, it's actually gonna be 2% less at 5.25. That second year, it's going to be 1% less at 6.25, and then that third year, it's going to be the full 7.25. Now, the reason why this makes sense is I don't think anyone out there assumes that we're gonna be sitting on 7, 8, 9, maybe 10% interest rates for the next 2+ years. I think we all believe that eventually this is going to calm itself down and correct itself. So this is easily and more than likely an option if you can get your lender to do it or find a lender to do it. It's called a 2-1 buy down. I highly suggest that you guys do this. Obviously not making any recommendations, but I would look into it, maybe have your local agent or your local lender give you a little bit more insight on it, but it is a good option, especially to kind of offset the ridiculously high interest rates that we're seeing right now. Now, if you are a real estate agent, I suggest that you at least bring this up to your clients, let them know that it potentially could be an option with specific lenders. This will give them an option to, hey, if they're relocating from out of state, they're not gonna be stuck up in an apartment with a 5-person family. They can still purchase a house at, a 5.25 interest rate. Next year it'll be 6.25. Just let them know that eventually you'll probably want to refinance. And that's probably gonna be the position that I wind up in December. I mean, obviously we don't know what the next 2 months and what the Fed's going to come back at us regarding inflation. Obviously, if it cools off, rates will cool off as well. But if inflation doesn't cool off, I'm likely gonna be stuck with a 7, 8, 8.5% interest rate in December when I close, and I'll do a 2-1 buy down with hopes of refinancing in the next 2 years. Thanks again for watching, guys. I just wanted to give you a quick update with the interest rates, unfortunately, hitting that 7% threshold today, and essentially all realtors and lenders talking about it on social media. I appreciate you guys watching. Make sure to like and subscribe. It really does help, and stay tuned for the next video.